Trustee Training.
Welcome to Trustee Training. I'm Katherine Patel. I'm a partner in Buzzacott's charity and not-for-profit team. My session is going to be looking at financial governance for trustees. So I'm going to be looking at the trustees' responsibilities in relation to the financial governance of a charity, and really this encompasses a number of different areas. So I'm going to look at audit and accounts, the investment side of things, internal control, briefly looking at reserves. I'm going to mention that within this session, but reserves really are going to be covered more extensively in a separate session with Eddie Finch. And then finally, I'll also look at going concern and the concept of going concern from an accounting perspective. So first of all, I'll start by looking at the requirements around the trustees' responsibilities in relation to the charity's financial statement. So the annual statutory accounts that the charity has to produce, and also looking at the audit, the external scrutiny of those accounts. So ultimately, the trustees have responsibility for keeping sufficient and proper accounting records. So this is your accounting systems, the invoices, the documentation relating to that. Trustees are required to prepare the annual accounts. So obviously that may be delegated to the finance team. And those annual accounts have to be prepared in accordance with the charity reporting framework. So the statement of recommended practice. The accounts will also include an annual report, often referred to as the trustees' report, and then the full statutory accounts, financial statements document, including the annual report, has then to be filed with the regulators. So as trustees, you must ensure that this happens. Charity Commission within 10 months of the year end, and for Companies House within 9 months of your financial year end. The trustees also need to ensure that there's appropriate scrutiny of the accounts by either appointing an independent examiner or an auditor. Which of those is really going to be determined by the level of income of the charity, and I'll cover a little bit more on that shortly. The Charity Commission also requires an annual return to be submitted at the same time as submitting the accounts, and again that has to be done within 10 months of the year end. Includes some additional information. And again, the trustees have overall responsibility for submitting that annual return. Obviously, depending on the size of the charity, it's likely that the charity's management and finance teams will be delegated responsibility for much of this activity and take that responsibility, at least in the preparation of the relevant documents. But it is important that the trustees are interacting with the management team, the employee team, finance team on this to make sure that everything is ticked off as is required, and that all reporting regulations are met, and that filing deadlines are also met with the relevant regulators, depending on the structure of the charity, whether you're just a charity or a charitable company. So looking a little bit more at the accounts themselves and the specific requirements that you're required to follow under the legislative framework. For those charities that are incorporated as companies, so companies limited by guarantee or potentially companies limited by share capital, then you'll need to follow the Companies Act 2006. And there are various requirements there in terms of company law. Charity law, also very relevant, and that will be dictated based on where the charity is based, so England and Wales, Scotland or Northern Ireland. In terms of the format of the accounts that you produce, smaller non-corporate charities, so this will include charitable incorporated organisations, CIOs, and then non-corporate charities, so those constituted by trust, for example, and with income up to a level of $250,000 per year, they can choose to use the receipts and payments basis for preparing the annual accounts. And there's a Charity Commission document that provides much more information in terms of how you do that and the format of the accounts. But actually more likely, and certainly for those larger charities and all charities that are incorporated, is that they follow the accruals basis of accounting and therefore follow the charity statement of recommended practice. So a document that's issued by the Charity Commission, available on the Charity Commission website, referred to as the charity SORP, and is a really detailed document that provides lots of guidance in terms of the format of your annual accounts, and also the trustees report that falls within that set of annual accounts. And in terms of that annual report, As I said, often referred to as a trustee's report. It's much longer and much more detailed. The requirements are much more complex than for a traditional company director's report. It's actually a requirement of the Charities Act 2011 or other equivalents if operating in Scotland or Northern Ireland. So for company charities, they follow the requirements of the SORP in respect to the trustee's report, and they can combine this with the corporate reporting requirements of a director's report and a strategic report in order to meet company law requirements. It would normally still be badged as one document, which is the trustee's report, but certainly for certain size charities, larger charities that are companies, you also refer to a strategic report within there, but covered by the charity SORP. All of the requirements for the content are set out within that charity SORP set by the Charity Commission. So in terms of the charity SORP, there is a threshold of 500,000 annual income. If a charity has income below 500,000, there are some simpler requirements for reporting, rather than if you're above the 500,000 threshold and are deemed to be a large charity, then further information will be required, such as a cash flow statement within the accounts. Again, the SORP draws that definition and really clarifies what's required if you're smaller or deemed to be a larger charity with income over the £500,000 mark. So you'll be reporting within your annual accounts and financial statements on an annual basis. In terms of whether you need to get those scrutinised by an external body, it really depends upon your asset and income levels within the charity. So as I'd mentioned, this is either an independent examination or a full audit. An independent examination is a lesser degree of scrutiny of the accounts. So if your annual income exceeds 1 million, then you would require an audit. Or if the gross assets, so the total assets of the charity, the total fixed assets plus the current assets, if they exceed 3.26 million and your annual income exceeds 250,000, again, you would require an audit. So that threshold in that latter point being lower for income because you have a higher asset base. So if an audit isn't required, it is likely that you'll require an independent examination. So if you have exemption from audit, but your income exceeds 25,000, then you will require an independent examination, and actually no scrutiny of your accounts is required, neither an independent examination nor an audit, if income falls below £25,000 in that year. The appointment of an auditor or independent examiner is made by the trustees. So an auditor must be appropriately registered, and there are many firms working within the sector who have experience of working with charities. For an independent examiner, that tends to be an individual who may be based within an accounting firm. So there are really two criteria here to look at, and again it's linked to the income thresholds for the charity. So if your income falls below 250,000 and you need an independent examination, the individual must be suitably experienced in being able to review those accounts and to confirm that your accounts align with the underlying accounting records. If your income falls below 250,000 and the 1 million audit threshold and you can appoint an independent examiner, then the independent examiner needs to be appropriately qualified. So you would expect them in this instance to have an accounting qualification and to be able to confirm that within the independent examiner's report. There is guidance within the Charity Commission website relating to both independent examinations and audit as well. So just looking in a bit more detail at the audit side and the appointment of auditors and the work that auditors would do, and linking that with the trustees' responsibilities on this. So the auditor's work is governed by international standards on auditing that operate within the UK and Ireland. One standard of particular importance and relevance to trustees is the International Standard on Auditing, ISA 260, that relates to communication with those charged with governance. So the board, the trustees, the directors being those who are charged with governance of the charity. And really it's making sure that ultimately the trustees are engaging with the charity's auditors For larger charities, there's clearly a distinction drawn between management team and those charged with governance. The trustees and directors have further responsibilities and will be delegating to the management team. And it is very important that the trustees understand what's coming out of the audit process, and that there is a dialogue with the charity's auditors. So often with the management team, they will obviously have the greater interaction with the auditors, in that the finance team will be preparing the financial statements, meeting with the auditors to discuss the audit outcomes. But this that really then has to be reported through to the trustee board with dialogue with the auditors also. And that might be via an audit committee or a finance committee potentially. The ISAs, and particularly ISA 260, they have a very corporate tone. So there is also a practice note issued by the Financial Reporting Council around the audit of charities in the UK. And it's interpreting that more corporate auditing standard guidance for the charity sector. So again, worth looking at when you're looking at the audit side of charities. So what would you expect to see as trustees of a charity in terms of the documents and the interaction with auditors during the audit process? So there'll be the letter of engagement, which will be updated periodically, probably not every year. This is really the contract, the terms of business that you're signing up to with the audit firm. And then annually, you should expect to receive an audit planning document. This may come through to the audit committee for discussion as well, but good to engage between the auditors and the trustees at the audit planning stage. So what are your concerns as trustees of the charity? Are there any particular risks or any areas that you would like the trustees to review in more detail? The auditors will be reporting within the accounts on their statutory audit report. And that will give the overview, the summary opinion in terms of the financial statements. What you're looking for there is a clean, unqualified, true and fair view being given within the audit report. The auditors will also mention going concern within here, and I'll come on to that slightly later in the session. In conjunction with the audit report within the statutory accounts, the auditors should also issue a post-audit report, a letter that sets out their findings and feedback from the audit process. So this may include a summary of any adjustments that were made to the accounts during the audit process, potentially observations relating to the charity's systems and controls as well. And then finally, there'll be a letter of representation. Again, this should be presented through to the trustees in the pack of documents that you see when you're approving the accounts. The letter of representation is a letter that the trustees sign and send to the auditors to confirm that they have given all information that's relevant to the auditors. It tends to follow a relatively standard template, so very much worth asking the auditors whether there's anything in there that they've tailored specifically to the charity that would be unusual or is putting a little bit more risk back on the trustees. So very much worth having a discussion with the auditors on that as well. So really the trustees' role in that year-end reporting is that onus to look at the audit plan, the audit strategy, review that, feedback to the auditors, get that input at the outset before the main audit work actually happens. You have your accounting policies and the presentation of these within the accounts document itself. Worth looking at those every year as well, checking that you're happy with those accounting policies. And then as a body, the trustee board will approve the accounts and reports, and very important that that is minuted. They may be reviewed by a finance committee, for example, in advance of the full board meeting, but really the finance committee is recommending to the trustee body that they can approve the accounts. The trustees as a group all have responsibility for approving the accounts. And for asking questions, ask challenging questions if you're unsure about anything that's reported within there. And then the trustees really are providing that information and explanations. And again, this will depend on the size of the charity. There'll be the letter of representation. Do you require any backing assurances from management as well? A number of my clients will ask the management team also to sign the letter of representation to confirm that they're also happy to sign up to the representations that are being made and may be worth considering. And really importantly, it's also considering the auditor's findings that have been given in the auditor's feedback report. You need to hold management accountable for those actions. How serious are they? The auditors should have some sort of rating in terms of whether they're really important issues or whether they're more housekeeping, control and system points that need to be done over a longer period of time potentially, or even are quite simple to fix. But trustees have to take that ownership and really make sure that the management team are held accountable, giving ownership to somebody within the management team for acting upon the recommendation, and also a timeline as well for making sure that the auditor's recommendations are actioned. So now just moving on to the investment side of things, the key document here, and it's available on the Charity Commission website, is CC14, Charities and Investment Matters. So this is the Charity Commission's consolidated guidance and brings in many of the aspects relating to investment. So this is looking at the sort of listed investment side of things, but also the more social investment side of things, which has obviously developed quite substantially over recent years. So it's really bringing together here the legal framework side of things, so including Trustee Act 2000. It's looking at how trustees should establish investment objectives and investment policies, when you should take advice and delegation of investment management to an external body, a professional firm of investment managers, for example. Also touches on ethical and socially responsible investment. So as trustees, how you make those ethical considerations, how you build those into your planning for your investment strategy. And then also looking at the more mission, charitable objective related investment motives. So there will be those social investments where you're putting money into a particular type of investment that won't necessarily bring you the financial return, but is being done for charitable purposes. And then very much looking here at the overall transparency and accountability as well. The importance for trustees of taking that responsibility extremely seriously. So those investments that you're putting money into to gain a return, probably for the longer term, and this will be a return both on the income side but also on the capital side, so looking for those future capital gains as well. So equity holdings, shares, paper debt, also properties. So any properties that you hold to rent would be classed as investment properties within the accounts, and you're also should form part of your investment policy. And then also unitised funds, so many of those that are available to the charity sector, for example. CC14 also looks at programme-related investments. So these are investments that are made more for a social purpose. So not necessarily to get a return, but nevertheless that the charity is putting money into a certain cause with the expectation that the money will be coming back to the charity, but they may not get that market return because they're enabling charitable objectives to be fulfilled. So, for example, that might be loans to other charities where they have a very low rate of return, which are enabling another charity to kickstart a project, for example. It may be loans to the beneficiaries of the charity, individuals, microfinance schemes, for example, or possibly shares in purely mission-related businesses as well. So these programme-related investments are separately categorised, and when you're reporting within your financial statements, the accounting treatment for these is also slightly different. And then there's a third group that CC14 refers to, and this is really mixed motive investments. And really, as it alludes to, it's a mix of investing for a financial return and also the programme-related social return as well, or social investment. There are sort of new areas where this is developing, and CC14 is really recognising that certain investments don't fall entirely within just one of the strictly defined categories of financial or programme related, but it can still be justified as being in the interests of the charity to make that investment. both from the sort of the dual nature of the return, which is part financial and partly justified by the investment's contribution to the charity's aims as well. CC14 doesn't go much further than that, but really it's relatively subjective in terms of the trustees sort of assessing those investments, but really making sure that you're clearly understanding the reasons for why you're putting money into a specific fund, particular equity, or a loan, for example, a particular investment. In terms of investment advice, so CC14, the Charity Commission, cover this very strongly and really requiring trustees to seek that professional advice unless trustees can reasonably conclude in all circumstances it is unnecessary or inappropriate. And I think when it comes to investments, it can be particularly complex and therefore most charities with a significant amount of money to hold will always delegate some of that responsibility to external investment managers and will get that professional advice with input from trustees who have the investment or financial background and maybe can challenge a little bit more to those investment managers. You should really make sure that that advice is given by a person, a firm that's reasonably believed to be qualified to give it. And there should be an agreement there as well. So if you're agreeing with a firm who will manage those investments on a discretionary basis, it must be governed by formal agreements. And really best practice, therefore, to agree the risk parameters and the overall strategy in writing. And pretty much all charities will be doing that if they're engaging with that external party. And that really leads on to the investment policy, because trustees with their external advisors can devise that investment policy, which is going to look at return and risk, balancing the risk and return for the charity, that you want that financial return to come into the charity from an income and or capital perspective, but you don't want to put the charity at undue risk in the future and therefore lose some of the value of the assets. You have, as trustees, that responsibility to safeguard the assets of the charity. So you may have some absolute measures within here in terms of returns, so monetary returns, or you may expect that your investment portfolio performance tracks some of the sector indices and benchmarks, which is the more typical way of doing it, because obviously the performance will be dependent upon the market at that point in time over the past 12 months, for example. You look at the asset allocation, and again, this is where the investment managers will be able to give some advice in terms of where you want to sit, given your sort of risk appetite and also the return that you would like to achieve from your investment portfolio. Agreement of all of this with the fund manager, and then also bringing in any ethical considerations. Obviously something at the moment that is under much discussion, the degree to which an external portfolio, a listed investment portfolio, can provide that ethical support to the charity, an ethical approach. So again, very much falling within your investment policy. In terms of the investments of a social nature, so I mentioned programme-related investments. So these are investments that are clearly related to the furtherance of the charity's objects. So they're held on the balance sheet as investments, as a separate category of investments. They're held at cost rather than the market value. Your financial investments will be held at market value on the balance sheet. And if you don't get your money back, any losses on programme-related investments, if you have to write off some of that loan balance, for example, that you've made to a charity, it would be classed as charitable expenditure. So rather than a sort of a write-off of an investment value, you're looking at that as charitable expenditure because you're supporting the charity's work in making that investment initially. It will have a separate accounting policy, disclosures as well. And then for mixed motive, so this is where there's an element of a degree of correlation with your charitable objectives, but equally a financial return, really making sure that you justify the reasons for making that mixed motive investment before you invest. It probably is likely to be a bit more complicated, so consider professional advice in this respect as well. Make sure that you're not creating too much private or personal benefit through making this investment, assess really why you're making it and that it is in the charity's best interests to make this investment. And really the power to do this is given, it's given by law. It was given in the Charities Protection and Social Investment Act of 2016. So it is expected that charities will be undertaking such investment activity, both from programme related and also mixed motive perspectives. So I'll now change tack a little bit further and look at the internal control side of things and really what a charity trustee should be considering from an internal control perspective. So the internal controls, and really internal controls in this context, are from a financial point of view. So where you're looking at segregation of duties, your scheme of delegation, approvals, authorisation. It's covered within a Charity Commission document called CC8, Internal Financial Controls for Charities. And this is really looking at the trustee's responsibilities through delegation to the management team where relevant, around the requirements for regular review of your internal controls, how you monitor the implementation of those controls, the financial controls. How do you know as trustees that those internal controls, the sign-offs, the approvals, authorisation of purchase orders, invoices, etc., payments, how do you know that is working as it should? You'll partly look at a budget for that. The budget will help you to assess the financial performance of the charity as you monitor financial performance through the year. If something hasn't quite worked on the procurement side or spend's going through that has not been approved, you may be able to identify that from comparisons against original budgets to management accounts. But actually, what more do you need to do? For larger charities, they often have internal auditors, and that can be an external body, an external audit firm that comes in and undertakes some internal control checks, or it might be somebody within the organisation, independent from the finance team, who is tasked with looking at some of those internal financial controls. Where are the risks that the charity faces? What are the controls that are in place to mitigate those risks? And how do you as trustees know that those controls are actually operating as the management team says that they are? Your external audit as well will look at some degree of controls and systems, and actually that will be increasing for 31st of December 22 year ends onwards. ISA 315 has been updated and there will be a greater responsibility for external auditors, your financial statements auditors, to document your controls. So there may be further value that will come out of the external audit as well in relation to those controls and whether they're operating and how they work. Your external auditors maybe be able to sort of feedback in terms of their comments on your internal controls and systems. Trustees need to pay, particularly at the moment, special attention to financial crime. So how do your internal financial controls mitigate against fraud, bribery, cyber threats? What are you doing? And internal controls won't always be effective. What is it that you can do to minimise the risk of financial crime? We see cyber security, data protection at the moment are huge topics. A number of not-for-profit charitable organisations have been subject to cyber attacks. So how do you make sure that your IT controls and systems are operating to mitigate the risk of that? As I said, closely linked to risk management, how do the internal controls protect against risk? How do your systems and processes protect the charity from undue risk? And for trustees to consider, as I said, trustees to consider how the internal controls are operating effectively in order to do so. Do you know that they are operating effectively? So moving on to reserves. As I mentioned, reserves are only going to be covered briefly in this session, and we have a more detailed session covering reserves. But there is, again, a lot of Charity Commission guidance around reserves. And why would a charity hold reserves? So for a number of different reasons, partly due to managing the risks of the charity. So you need a financial buffer, you need those reserves, partly held in cash, in case of future reductions in income, an unexpected cost that you were not anticipating coming through. And then maybe known contingencies. So as a charity, what are your risks and what sort of level of buffer do you need to hold for that rainy day, for the contingencies? Also for working capital, so you do need that cycle of cash coming through and the reserves level in order to maintain your payments that are going out and the money coming in. So that sort of trading cycle, the working capital levels. And also potentially for charities that have a more cyclical or seasonal cash flow, you may again need a bit of a buffer to protect against when cash flows are lower during the course of the year. And maybe for other strategic reasons as well. So you may be looking at investment opportunities. You may have a building that you know is needing a new roof, for example, at some point in the future, or a huge refurb, and that you're saving up some reserves for future asset purchases, refurbishment, etc. So the key document for trustees is CC19, Charities Reserves Building Resilience. And within there, it requires trustees to develop a reserves policy. So really, for the trustees to be able to fully justify and clearly explain why they are holding their financial reserves. The reserves policy is required to cover free reserves. So the free reserves of a charity are those that are not restricted or ring-fenced or tied up in tangible fixed assets. So excluding anything that's illiquid and excluding anything that you're holding for specific purposes. And it's really looking at the level at which those funds should be held, ideally based on your assessment of the risks, of the working capital requirements, etc. In order to maintain those essential charitable services to your beneficiaries. So reflecting the risks of unplanned closure associated with the charity's business model, spending commitments, potential liabilities, forecasts, really for your finance team to be bringing all of this together to assess what your level of free reserves, your reserves, should be, and really helps to address the risk of unplanned closure on the beneficiaries of the charity. So particularly where you have vulnerable beneficiaries, staff and volunteers, you don't want a sort of a kids company example where suddenly the doors have to be shut and you can no longer provide that charitable service. So CC19 requires that you publish your reserves policy, and this is done within the annual report and accounts. So what are the actual free reserves of the charity? So they're reported within the accounts, and you look at those in the context of your target for your free reserves and the policy that you've set. If there's a gap, then you're explaining how that gap will be addressed. As I said, there's more information provided in a separate reserves and risk management session, so listen to that one if you need to find out more in relation to reserves. Finally, just to make a note on going concern, which is really looking at the financial solvency of the charity. So going concern is a real accounting convention. It's a responsibility for the trustees to consider the financial solvency of the charity, and that's looking at a period of at least 12 months from the date of approval of the annual accounts. So potentially you have a March year end, you go through the audit process, the trustees approve the accounts in October, then you're looking 1 year from that approval date in October, so to October the next year at least. And what the trustees are looking at here is that the charity has sufficient funds to pay its debts as they fall due, so remains financially solvent. Assuming that the charity will remain solvent, this is referred to as the going concern basis for the preparation of the accounts. The trustees are making this assertion within the accounts, and the auditors will also audit this assertion. So it's likely, and particularly where your charity is suffering some financial uncertainties, it's very likely that the auditors will be challenging both the management team but also trustees, the finance committee, audit committee maybe, in relation to going concern. You may have a paper that's put forward to the trustees at the time of approval of the accounts that talks about that 12-month period and the cash flow within that period. As auditors, we will also sign off within our audit reports within the accounts on going concern to confirm that we support and agree with the trustees' statement on going concern. So there are various disclosures the trustees make, both within the trustees' reports and also within the accounting policies, and confirm that they are following the going concern basis for the preparation of the accounts. And that's really the sort of the normal position. Ultimately, a number of charities, not-for-profit organisations are struggling at the moment. And if there are concerns about whether you're a going concern or not, the warning really is that trustees have to act extremely carefully. That's the point that you should be having an immediate discussion with professional advisors, your auditors definitely, and potentially lawyers. You must avoid the risk of trading insolvently in that circumstance. It will obviously affect the accounts as well in terms of the disclosures that you're making. So that concludes the financial governance part of the trustee training. Many thanks for listening.